There we go. Hello. Can you hear me through the stream, Derek?
Yes.
Okay. All right, I got to do a couple things here. Give me just a second. Alex, do you have your camera on? All right, I'm waiting for Alex a second. Now I've got you. Can you hear me, Alex?
Yes, I can. Can you?
Yep.
Awesome.
So you will need to mute your microphone, or you'll need to mute the stage. So when you do get into the venue, you don't have to go into the venue, but if you, yeah, you do. When you go into the venue, you're going to need to hover on the stage, which is where the live presentation is, and then you're going to need to mute it. There's a unmute button on the stage, otherwise you'll get an echo.
I get there.
So Derek is also in the venue testing audio for us. So Alex, do you want to just talk for a minute and let's make sure that Derek can hear your audio okay on the stream?
Yeah, of course. 1, 2, 3, test. Can anyone hear me? I'm Alex from LifeWorks, trying to test audio here. Is it working, guys?
It's. I'd say it's pretty poor.
It's echoey.
Okay.
It's echoey? Okay, hang on. It could very well be something on my end that's causing that echo. Go ahead and keep talking for me, Alex.
Yep. 1, 2, 3, 4, 5, 6, 7, 8. France has the greatest soccer team in the world, but we still lost, which is extremely sad. 1, 2, 3, test. Can you guys hear me well?
Okay, Alex, so are you in the venue right now as well?
Nope.
No, you're not in the venue?
Should I get in there?
Well, I'm just trying to figure out why it's pumping your sound back in like that. All right, try talking for me again.
1, 2, 3, test. Can you guys?
Hey, Derek, can you stay out here a second so I can hear his audio? Derek, can you stay out here for me a second so I can hear his audio? Stay out here for me a second so I can hear his audio. Okay, go ahead and talk, Alex. Okay, go ahead and talk, Alex. Okay, go ahead and talk, Alex.
One, two, three, test. I'm trying to talk just to make sure I can be heard. 1, 2, 3. You guys hear me?
Yeah, we can hear you.
Awesome.
You're echoey though, and I'm trying to figure out why.
Awesome.
You're echoey though, and I'm trying to figure out why.
Awesome.
All right, go ahead and keep talking for me a second, Alex.
LifeWorks Advisors, best RIA in the world. 1, 2, 3, 4. LifeWorks Advisors, best RIA in the world. 1, 2, 3, 4. LifeWorks Advisors, best RIA in the world. 1, 2, 3, 4. LifeWorks Advisors, best RIA. 1, 2, 3 test. Can you guys hear me? Sounds better, right? One, two, three. Is it better now? Can you guys hear me? LifeWorks, Run Buddies, Darren Vermeulen, X. X.
I think we finally got a winner. I think we finally got a winner.
Turn your mic off a second for me, Derek.
I think we finally got a winner.
Just mute your mic. Keep your volume up, but mute your mic.
Okay, maybe another one.
Just
You guys hear
mute
me
your
well?
mic. Keep your volume up, but mute your mic.
Okay, maybe another one.
Just mute your mic. Keep your volume up, but mute your mic.
'I can hear you. Can you guys hear me well? I'm trying to. One, two, three tests. Can I be heard? Is it working well? Trying to keep speaking. Trying to keep speaking. Trying to keep speaking. Trying to keep speaking. 1, 2, 3, LifeWorks advisors. 1, 2, 3, LifeWorks advisors. 1, 2, 3, uno, dos, tres, LifeWorks advisors. Grand Rapids, Michigan. 1, 2, 3, uno, dos, tres, LifeWorks advisors. Grand Rapids, Michigan. 1, 2, 3, uno, dos, tres, LifeWorks advisors. Grand Rapids, Michigan. 1, 2, 3, uno, dos, tres, LifeWorks advisors. Grand Rapids, Michigan. 1, 2, 3, LifeWorks. 3, 2, 1, 0. Test, test, test. Can you guys hear me?
All right, let's try again. Alex, can you talk?
Yes, sir. 1, 2, 3, Mr. Run Buddies. I can talk right now. Let me know if I should try more. Can you guys hear me well?
Yep, keep talking for me.
Okay. I'll just keep rumbling then. I will read an email.
Okay. We got about a couple minutes. Is it echoing? So my problem that I'm having right now, for some reason, Alex, is when I turn on your audio and mine at the same time, we get this echoing loop, and I don't know why.
Mm-hmm.
I'm trying to fix it real quick. All right, keep talking for me a second, Alex. Keep talking for me.
This is a reminder that you've registered for live market update in 1 hour, 12 p.m. EST. Keep in mind, market update, blah, 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 blah.
All right, we'll have to figure this out later because we got 4 minutes. All right, keep talking for me a second, Alex.
1, 2, 3. LifeWorks, RIA, tech company, flourishing startup. Can you guys hear me?
That was loud and clear.
Awesome.
All right, try now. Keep talking.
1, 2, 3 tests. This is a reminder that our market update will occur in 30 minutes.
Derek, can you hear that? Can you hear Alex talking?
1, 2, 3 tests.
Derek, could you hear Alex talking?
Yes, that last one was echoey.
The last one was echoey. Try it one more time for me, Alex.
Trying one more time, trying to see if it's echoey. Is it? 1, 2, 3, LifeWorks.
Echo, echo, echo.
Derek, how about my microphone? Is mine echoing right now? Or is mine fine?
No, you are loud and clear.
I am loud and clear, but Alex is echoing. All right, let's try again. Keep talking for me, Alex.
1, 2, 3. This is another try. Am I going?
Derek?
Echo, echo.
Echoey. Fuck. All right, well, I'm just gonna have to cut my mic when Alex goes to talk. So Alex, you and I just won't be able to talk at the same time.
Okay. I- If it is, then just trying to think. Should should we agree beforehand when I should speak and stick to the program? I don't know, just offering. Sounds good. Do you have me in the Q&A now? Yeah.
All right, Derek. If anybody is joining us this morning, we are just doing a quick audio check before we go live here. So don't mind us. We are just doing a quick audio and video check for those of you that might be in this live Q&A session already done. I see that you're in here with us, so don't mind us. We're just testing our audio. Alex, go ahead and do a mic check.
One,
ahead
two,
and test.
three. Mic check.
Okay. Keep talking for me a second.
Hi everyone, this is Alex. Yeah, you have LifeWorks.
If you're on your computer and
What
want to
up,
do that,
Q&A
you should be ready to go.
Okay, just waiting for one more check real quick, Alex.
Okay, 1, 2, 3. One more check. Last check. 1, 2, 3. 3, 2, 1.
All right, keep talking. I'm going to see. I'm just checking Derek's output here a second, making sure he can hear you okay.
Sounds good.
Can you
Derek,
hear Alex?
I'm in the Q&A.
Can you
One,
hear
two,
Alex talking?
I haven't heard of him.
All right, keep going for me, Alex.
1, 2, 3. Alex Matekatara, CIO at LifeWorks. Testing my microphone.
All right, keep going. Talk a little bit more for me, Alex.
1, 2, 3. LifeWorks Advisors, RA in the United States of America, holding a market update in 20 minutes now.
Hey, Derek. Can you hear him yet? Still can't? How about now? Can you hear him now? Go ahead and talk, Alex.
1, 2, 3. Testing my audio. Can you hear me well, Derek?
All right, Alex, test your mic for me one more time.
Testing microphone, 1, 2, 3, live for supervisors.
Derek, can you hear him?
No.
You still can't hear him, huh? What did I do? I must have just somehow turned off his audio. All right, keep talking for me, Alex.
One, two, three, testing. Can I be heard? Audio test, 3, 2, 1, 0.
Derek, can you hear me coming out on your stage, or do you have your stage muted?
Talk one more time.
Testing 1, 2, 3. Testing 1, 2, 3. Mic check 1, 2, 3. Testing 1, 2, 3. Testing 1, 2, 3. Mic check 1, 2, 3.
I've got you.
Okay, Alex, try and talk for me one more time. Okay, Alex, try and talk for me one more time.
This delay kills me.
One, two, three, test. Is this working? 1, 2, 3, audio test. 1, 2, 3, test. Is this working? 1, 2, 3, audio test. One, two, three, testing my mic. LiveFox Advisors.
All right, try it for me one more time, Alex. Last time.
1, 2, 3, audio test. LiveFox Advisors.
All right, guys, that was operator error. I had the button mic'd on my audio. Can all of you guys hear me okay now? Awesome. All right, well, let me start that over again. Good morning, everyone, or good afternoon now. It is 12 o'clock. Ron Bullis, the co-founder and CEO of LifeWorks Advisors here. We are really excited to have you join us for our year-end client market update. I have Alex Matei-Cathala, our Chief Investment Officer, who'll be live streaming in as well. He has returned to France for the holidays, so he's visiting his family in France, so he's going to be live streaming in from there. This is a newer product that's created by Vimeo, and it's called Venues. We're going to be using it for hosting our live events going forward. I've been using it with advisor events and internal team events now for the last few months in a beta test program with them, and we really, really like what it does in terms of interaction, what the live Q&A is going to look like, and how we can bring our LifeWorks events to clients like yourself. So before we get going too far, let's just take a quick tour around Venues here so you guys can see how to interact with me while I'm presenting, some fun features, how to chat, things like that. If you look at the bottom of the screen, you should see a little menu bar. One of the things there is a little smiley face where you can post reactions, GIFs, emojis, things like this. So everybody just have a little fun with me for a second, post something there so I can see you guys found that one okay. Got it. Perfect. Awesome. Sitting right next to that, thanks for raising your hand, Bob. Sitting right next to that is also a little chat icon. If you click on that chat icon, there will be a chat log on the right-hand side of your screen where everybody can chat back and forth. You can also message people on a one-to-one basis. So if you want to message Alex, who's on here as well, ask him questions during my presentation, you certainly can. That would be, that's welcomed and encouraged. So this is a really cool software that Vimeo asked us to beta test with them. And so be patient with us today. If we have a couple of snafus or a couple of issues with the audio as we're going through, it's probably operator error because I'm the guy pushing the buttons behind the scenes. And we're going to have a good time here today. When I'm done with my main presentation, and I'm going to pull Alex in for part of it, what you're going to see in the bottom left-hand corner of your screen, you should see what's called a hamburger menu or 3 horizontal lines. If you click on that right now, you'll see that there's basically 3 options. There's leave, there's the main stage, which is what we're in now, and then there's the Q&A session. When I finish up the main presentation, I'm going to jump over to the Q&A session. I'm going to turn my mic and my camera off for a second, grab a drink of water, maybe a coffee, and then I'm going to kick the live stream back on with both Alex and I, and we're going to take your questions about the economy, the markets, LifeWorks, investment strategies, or anything you want to throw at us in the Q&A session. So during my presentation, if you want to ask a question, throw it in the chat. Either Alex will try and answer it in real time, or if I can work it into my presentation, I will do that as well. Above all, let's have fun. So I hope that each one of you guys finds this presentation to be informative and interesting. And again, and I hope that this Venue, this software that we are using, allows us to have really rich interaction back and forth with each of you, which is something that we've been trying to figure out the right venue and platform for doing that now for some time. All right, I'm going to get my presentation kicked off. Again, feel free to throw questions my way via chat. Alex will also be in there as well, answering as we go. Looks like Derek's also on too. So Merry Christmas, everyone, and let's get started. All right, so we are first going to have a conversation about the economy. If you've been on any of our client market updates before, you know that both Alex and myself and the rest of our team will spend a lot of time trying to help educate and cut through the noise of what's going on in the markets and what's going on in the broader economy. So we're going to start today by looking at the lens of the economy and what's going on there. Probably the most important place to start, or at least one of the most important places to start, is a conversation about inflation, right? So what we've seen this year is what Alex would term a regime change, or a significant shift in what's been the normal or the status quo now for a couple of decades, right? So I'm sure all of you are aware that this year we've seen a return to inflation levels that we haven't seen since the 1970s. Now, what we're looking at in the chart here is the light blue bars are the change on a month-over-month basis in CPI, or the Consumer Price Index. On the left axis, the dark blue bar, what you see is the annual change on a year-over-year basis. So the important takeaway here is, one, inflation has really, really ramped up this year. In fact, anybody who's bought groceries, I feed 4 children, and my grocery bill this year has definitely gone up. Anybody that buys groceries, utilities, that's looked at even other goods and services, has noticed that the price of these things has gone up significantly. However, maybe a glimmer of hope here is that the pace of the change in prices is slowing down. So what we see with the dark blue line here is that in early fall of this year, we started seeing the month-over-month change in the Consumer Price Index slowing down, which is pulling the year-over-year change down some. Now, is 7% inflation on a year-over-year basis better than 8? Yes, that's better than 10. Is it better than the 2% target that the Federal Reserve has? Well, no, because part of the problem is, until the Federal Reserve tames inflation, they're going to continue raising interest rates. Alex is going to talk about the impact of the Federal Reserve's monetary policy and interest rate policy shortly. But until the Federal Reserve sees what they would say is inflation coming back down to their target level, which is 2%, they're likely going to continue to raise interest rates, which is going to cause pain points and pressures in different parts of the financial markets and the economy. Another one here to look at is something that Alex would call inflation for purists. So the Consumer Price Index, or CPI, is probably the most commonly talked about measure of inflation for consumers, or what you might see if you're watching talking heads on the news or if you're browsing online. However, there's another measure, that's the Personal Consumption Expenditure Index, the PCE index. And this is actually calculated by the Dallas, one of the Federal Reserve branches, the Dallas branch. And it's slightly different. Whereas the CPI is a measure of goods and services at the consumer level, this is a measure of the price change of the consumption inputs, right, that would go into those goods and services. It tends to be a little bit less volatile, and it tends to be smoothed out when you're looking at it on a year-over-year basis versus CPI, right? So what we're also seeing here is the same thing. Again, the dark blue line is the year-over-year change, right? And the blue line is the month-to-month change. So while we still see inflation by this measure significantly higher than we have for the last decade, what we also see at the very end, the very far right-hand side of your screen, is that it seems to have peaked and it's starting to pull down. Now, this is probably a good thing for everyone, right? However, what we'll be talking about and showing in a couple slides is it doesn't necessarily mean that the U.S. economy or the global economy is necessarily out of the woods or isn't potentially staring down the barrel of, if not a current recession, a very looming one in the near future. Another one here for all of us that have cars and drive. I guess even if you have an electric car, you've probably been paying more for your electricity as well. But the cost of gasoline, this one hits consumers directly. It has a significant impact on the economy. And prices at the pump, as measured by the American Automobile Association, are now below their level on the eve of Russia's invasion of Ukraine. So over the summer, we saw a really massive spike in the price of gasoline, which would also, translates into a spike in diesel prices, et cetera, which is a factor into the goods, the cost of goods and services. So it was an inflationary event. But what we can see here from this is that the price of gasoline, the average price of gasoline in America, has returned to the levels that they were at pre-Russia's invasion of Ukraine, right? Now, this has been a big upward pressure on inflation, and it seems to be easing. Now, I probably should have maybe had a quick conversation about why inflation is important and why it's something that we're constantly talking about. So let me just back up real quick here. One of the biggest challenges for people who are, I'll segment it. One of the biggest challenges for people who are retired. I'll use this as an example first, and then I'll maybe use myself at 41 years old with 4 kids. But for people who are retired, one of the most significant risks they face is not a loss of principal on their investments, it's a loss of purchasing power. It's a loss of ability to sustain their standard of living across their lifetime in retirement. And inflation is the enemy here, right? Inflation is the number that erodes people's purchasing power, right? So for retirees that are living off of their investment portfolio or living off of a fixed income from pension and Social Security, inflation is the beast that is the most painful and most challenging one that needs to be addressed. So it's an extremely important thing to understand both what's happened with it and where it's likely to go, right? As an example, if the inflation rate is 10% in any given year, right? That means we're losing 10% of our purchasing power. So if somebody's on a fixed income and their income's not changing and inflation drives the prices of goods and services up, the only choice for that person is to buy less things, to consume less. And for people on fixed income or for retirees that are living off of income from their investment portfolio, these can make that individual have to face hard decisions, or potentially even face a situation where they have to start withdrawing their principal or living on other sources of assets or something like that. So it's a really tough thing. Now, on the other side, for those that are still working, saving, investing, building families, inflation is still a beast, just like it is for retirees, but the challenge there is it actually constrains the amount of free cash that a family or an individual would have to save for the future, to invest, and to consume, right? So inflation has this pervasive impact across generations and across the markets, and it's something that the question mark is still out as to whether the Federal Reserve can even control this, or whether it's something that's more impacted by the overall business cycle in the economy. So we'll get to that more. I decided to pause here a second and kind of give some backdrop as to why inflation is important. For retirees, it's one of the number one challenges they face is to, not have significant losses to their purchasing power in retirement. And for younger people that are still in their working career and in their working years, it directly impacts the amount of money that we can spend or that we can invest for the future, which creates significant challenges for the economy. So let's step back to my presentation here a second. So gasoline or energy prices would be one of those factors that would be being calculated in inflation. All right, another sign or another graph here that points to inflation slowing down and potentially some good news for consumers, for businesses, for investors, retirees, is that the pace of energy commodities, the change in price there appears to have been slowing down. Okay, so energy commodities, we were just talking about gasoline. This one's a little bit more encompassing. So this one's going to have electricity, things like that in there as well. So for all of us, we saw during COVID, right, a significant drop in consumption of energy, which reduced the prices. But since then, it's been on a pretty significant increase over time. And energy is also one of the main inputs into the cost of goods and services, which is driving inflation for us at a consumer level. Now, the one area that seems to still be going quite strongly on the inflationary front is the pace of services inflation. So CPI measures goods, right? So think food, material, lumber, physical things, right? Inflation as a measure of the service economy, which is a significant portion of the US economy, seems to still be moving in an upward trend. It doesn't seem to be slowing down. So this does present some challenges for all of us that use services. So you using LifeWorks as a service, the wages that are paid to people in the service industry, et cetera. The change in prices of services seems to be discoupled or decoupled from the change in the consumer price index. All right, I'm going to pull in Alex here a second, and I'm going to have him unpack. So give me just a second so I can get his audio set up here. I'm going to have him unpack the next couple of charts. All right, go ahead, Alex. Take it away.
Thank you, Ron, and hi everyone. Merry Christmas. I hope you can hear me well. I would like to really quickly, before I get into this chart here, would like to add one item on what Ron just said about services inflation versus good inflation. I'm going to be talking about asset prices and decisions by the Fed, and I'm going to use the word uncertainty a lot, or risk, or unknown over the next few slides. And one of the reasons why I'm going to use this word is because, as Ron just said, services inflation in particular is still significantly high. And policymakers and fund managers and asset managers are facing an unprecedented situation, in the sense that last time the USA had such high inflation in the 70s, as Ron mentioned, the weight or the importance of services in the American economy was so much lower, was much less important than it is today. So people have no historical reference to help them make decisions on how to set rates to curb inflation, for example. That's just one point I wanted to add, which I think is extremely crucial. And so now we have a few slides moving from inflation to the effect from inflation on asset prices and on investment returns. One way inflation feeds into the returns you can have is by having an impact on interest rates. So let's imagine you're an investor into a company. What you own is equity of this company, right? So the first effect inflation has on your equity ownership is obviously through an increase in the revenues of this company, most likely, due to the fact that inflation is bringing their top line higher. But inflation is also affecting their costs. So that is one thing. But another way inflation is going to affect that company or this company's valuation is through interest rates. So when you own equity, you basically own a share of future profits. So if I simplify, you own some future cash flows. And one thing is to know that you will receive cash flows in the future. Another thing is to know how much these cash flows are worth. So let's imagine it's a simplified world and you own equity into a company that's going to give you a cash flow of 100 in 10 years. This cash flow can be worth a lot if interest rates are super low and you have no other opportunity to invest in the economy. But this cash flow in 10 years in the future is extremely worthless if inflation is very high and interest rates are very high as well. And the most important factor of those interest rates, which are a most important driver of your equity valuations or bond valuations for that matter, is the policy of the Federal Reserve of the United States. So this plot you see here is the projection of the Federal Reserve's governors and some other high-ranking officials at the Fed that are meeting as a group called the FOMC, the Federal Open Market Committee. And every quarter they publish that projection, and every dot here represents one forecast by one of those 19 members of this committee for their target Fed funds rate in the future. So if you see 19 dots, 19 blue dots at around 4.25 for 2022, It means 100% of those members, 19 out of 19 of them, thought that the appropriate policy rate to be able to curb inflation without killing the economy in December 2022 would be 4.25. If you go 1 year in the future to 2023, you see 19 dots again, and 17 of them are above the 5% threshold, which means that the vast majority of the FOMC members think that next year their policy rate, another word for this rate is the Fed funds rate, because that is the rate at which banks can borrow or lend to other banks and to the Federal Reserve. This rate will have to go above 5. On average, not on average, but as a median, 5.1%. And the very important information comes when you go 1 year further in the future, 2024, 2025, and you see that there is a lot of uncertainty. By the way, those plots show a lot of dispersion. So they were very much gathered, very much close to one another in 2022 and 2023. In 24, 25, there is no consensus at the Fed. Why so? Because there is no reference model, there is no historical comparison to help them make an easy decision. So keep that one number in mind, 5.1%. This is the 2023 median estimate by those Fed officials as far as their policy rate is concerned. So now we're going to move to the next slide, where you will have not only those Fed officials' estimates, is a percent number, and that is the number at which the Fed funds rate should be set in the future. So when you see this light green star at the bottom left of the chart, it means that in November 2022, the Fed fund rate was officially set at this number, 375 or 4%. The blue plot, as opposed to those green stars, is the prediction by the financial markets. So financial market participants have a very reliable way to tell us about their future estimates of this rate by sort of gambling, or rather selling and buying some future contracts. You know, hundreds of billions of dollars are involved in those transactions. So we can take the information from those transactions at face value to understand what the market is thinking. So what you see here is that this plot is going up until some point in the middle of 2023, which means that the market thinks the Fed will increase its rate until the summer of 2023. But after this plot goes down because the market thinks and the market is betting money on the fact that the Fed will be forced to pivot at some point in 7 or 8 months, probably because of a harsh recession. The Fed will be forced to pivot and lower their rates so as not to crash the economy too much. So, for example, if you look at this blue plot at the extreme far right of this slide, you see that the market thinks that this rate will decrease to 4.25, exactly like it is today, in a year from now. Now, why is that important? Because this estimate by the market is what is driving valuation of all asset prices across the board. Equities, bonds, when institutions price assets and they sell and buy, they use this as their assumption, and that tells them how much such or such asset is worth. Now, where there is an issue here, if you remember, the previous slide said that the median Fed estimate was 5.1% in December 2023. This means that the market thinks that the Fed is lying, or that the Fed is not able, will not be able to be true to their promise of hiking rates that much. Or in other words, the markets think that by rising rates more, just like the Fed is saying it will, the economy will crash. So now if we move to the slide after this, you will have another indicator to show that the market thinks the likelihood of a recession or a crash is higher than what the Fed thinks. So this is a very popular metric to be able to try and predict when a recession will happen. It is not a bulletproof metric. It's just one of many metrics, many items that people look at. But in no way is it 100% reliable. So what it shows is the difference between the 10-year and the 2-year yields. So, the US government, just like individuals, borrows money sometimes, and they get a different rate based on the horizon they borrow money at. So you have a certain 10-year yield, and you have another 2-year yield for the US government. When the economy is growing, it is assumed that the normal behavior of the so-called yield curve is such that the 10-year yield is much higher than the 2-year. The economy is growing, everything is normal, so over time there's a little more risk, so you just lend to the government at a higher rate over over a longer time period. So that was the case in December 21. We had a positive number, which meant that the 10-year yield was higher than the 2-year by about 0.8% or 80 bips. Today, in December 22, this number is negative. That means that the US government is borrowing at a higher cost over 2 years than 10 years. So why is that recessionary as an indicator? That is because if you take the implication of high rates over 2 years and lower rates over 10 years, that means at some point between 2 and 10, so at some point between year 2024 and 2032, rates will have to go down, or in another word, the Fed will have to lower its policy rate to support the economy.
So we just had two indicators of a probable, of a likely recession. We have another one here. It's an easier one to explain. You have the ratio of the performance of equities pertaining to two different groups. One is discretionary firms or discretionary product firms, that is companies that sell things that you don't have to buy if you don't have the money for it. For example, luxury cars, the lodging industry, airlines. And the other group is staples. So the most basic example is a toilet paper. So on one hand, you have, I don't know, the stock of American Airlines, which is something that is extremely sensitive to recessions or booms. When people have extra money, they tend to fly much more. When they have less money, when there is a lot of unemployment, airlines crash as equities. Toilet paper, on the other end, those firms, they just grow at 2% a year for the next 100 years, whether there is a recession or a boom. What you see here on this chart is that over the recent past, the performance of those discretionary equities has been extremely poor compared to staples. That means that the markets think that over the short and medium term, companies that sell things that are discretionary are going to struggle because people will not be able to afford them. So now that you have this situation in mind, we can look at the broader picture and look at the trend on real yields. So those are the yields, that is the interest rate at which the US government is borrowing, adjusted for inflation. So this is, I would say, the first piece of good news of this presentation. What you see in the dark blue plot is that over the recent month, the cost of borrowing has been lowered a little bit compared to the trend that was going on since early 2022. There is still a very long way to go, because if you look at the trend, the underlying trend, which is represented by the light blue plot, that is a commonly used metric, that is the 200-day average for this yield. What you realize that the gap between the dark blue plot and the light blue plot is still somehow significant, but it is narrowing a little. So there has been a slight shift, which has been mostly brought about by inflation decelerating, as Ron mentioned and showed in our first few slides. The next slide is putting the US on the side and focusing on China. There was a good reason why I wanted to spend some time on China. We often neglect it. I mean, when I say we, I mean the financial community or the investment industry. But it's very important to keep an eye on it. Not necessarily owning Chinese equities, but admitting the fact that what happens in China today moves pretty much everything around the world. The Chinese output every year is now about 17 or 18 trillion in US dollars. That compares to the US 21 or 22. So you see that those two economies are pretty much the same size. It's widely admitted that there is a strong link between the health of the Chinese economy and the level or the value of the US dollar, for example. When the Chinese economy is doing super well, capital tends to flow to China and in part away from the US, for example. which makes the dollar, for example, less valuable. And just one impact of this is that US exporters, due to their currency being undervalued now, perform much better, right? The dollar is cheaper. Foreign people can buy US goods at a lower price, at a lower local currency price. So US exporters are doing well. That's just one example to show you how the Chinese economy has a huge impact on the US one. What you see on this chart is two plots. One compares the performance of Chinese equities to the performance of US equities. That's the dark blue plot. And the other one compares the performance of Chinese equities to the performance of emerging markets equities, excluding China, and that is the light blue plot. The important information to retain here is that China has been doing extremely poorly until the past month and a half or so. Those two ratios were going down by a lot, which means that Chinese equities were underperforming, for example, American equities by about 70% over this past 18 months. The zero COVID policy implemented by the Chinese government had a huge impact on their economy, which made everything slow down, of course, and made their companies struggle a lot. When it was changed, or more precisely, when it was stopped about a month and a half ago, Chinese equities starting to soar again. So you have an outperformance of about 30% over the past 2 months. As I said, this is going to have a huge impact, and it already has one. For example, on the value of the US dollar, which has been going down a lot over the past 2 months. So you see, zero COVID policy in China being repealed, huge impact on the US, because huge impact on the currency. But that has an even greater impact on emerging markets. As a reminder, all, or not all, but most third world, or I should say emerging countries, rely on commodities, and they rely on credits. When the Chinese economy is doing well, commodities are priced higher, and they can sell those commodities for a higher price to China, but also Europe and the US. And when the US currency is doing less well than the Chinese one, for example, the cost of debt for those countries, which is most of the time denominated in US dollars, when the US dollar is weaker, the cost is much lower. So those emerging countries are doing better for that reason too. I wanted to get back to the US real quick after this travel to China, and wrap up this first half of the presentation by talking about uncertainty again. And that would be slide number 15, I think, Ron, if you can get there. Let me check. Or 16. Yes, awesome. Thank you very much. So that is just to echo the dot plot by the Fed, when you could see that the Fed governors were in sharp disagreement with one another because they are not clueless, but very much uncertain. Here you have a chart that shows you how much strategists, that is high-ranking and very well-respected equity investors, how much they disagree on what is going to happen next year as far as the S&P 500 is concerned. So this plot shows you a percent number. That is the spread between, so you have a group of strategists, and you take the most bullish person out of this group, and so they have a target for the S&P 500, and you take the least bullish or the most bearish person, and they have a target too, and you see that this spread for next year is the widest it's ever been, almost since 2009. So remember what happened in 2008. In 2008, those people made predictions. There was a lot of risk in the economy. They disagreed a lot because there was the great financial crisis. Well, today, the situation is such that uncertainty is just as high as back then. Now I think I will pass the mic again to Ron. But that was really, I think, the most important word here for the slides I covered: uncertainty, uncertainty, uncertainty.
Thanks, Alex. And again, for those of you guys who joined us a little bit late, we are testing out a new platform from Vimeo called Venue. So we're experiencing a little bit of audio and video delay, feedback issues. Most of it's because I'm the AV guy today running this behind the scenes here. So I apologize if we have any audio issues or something cuts in, cuts out. We're learning on the fly. Thanks, Alex, for sharing a couple of those really key slides about the economy and for the discussion about China and federal market policy. I was having a conversation with one of our advisors a couple of days ago, and I said to him, the amount of uncertainty that's in the market is a really great reminder why we need to turn off the talking heads on cable news, who are what Alex refers to in his paper about demystifying the markets that you can find on our website. If you go to lifeworksadvisors.com, under philosophy, there is an article that Alex wrote called Demystifying the Markets. The talking heads, the pundits, the strategists, the people that try and predict the outcome of the market are essentially market timers, and we refer to them as charlatans because it's impossible to know. So I was having a conversation with one of our advisors the other day discussing some planning for one of their clients, and I said to him, look, let's just remind ourselves that the reason that LifeWorks built the really innovative methodology that we use for you, our clients, where we focus on timing your liquidity needs, timing the cash flow that you need from your investment portfolio, instead of trying to time the market. The amount of change, the rate of change that we've experienced in the last year is the slowest rate of change we'll probably experience for the rest of our lives. It's not as if at some point in time things are going to magically become less volatile or geopolitical uncertainty is going to, become less of an issue. Right? It's likely that due to technology, globalization, and even things that have happened post the COVID era, right, has shifted how governments think about locking down economies, controlling societies, information flow. And I'm not saying this from a political perspective, just from the reality that we live in. Trying to guess where the market's going to be in a year is a futile exercise. And at LifeWorks, we don't do that. What we do, and this is just a quick reminder here before I get to shift, Alex kind of got to talk about some of the downsides of what's going on in the economy. I'm going to shift gears and LifeWorks investment strategies broadly have performed in 2022 and then since inception, but I thought it was really important before we get into a conversation about performance to remind ourselves that we build investment portfolios for you, our clients, based off of when you need to spend the money. Because we have some ability to time the liquidity needs or to time the cash flows, we have no ability to time the markets. So if you're new to LifeWorks, you've probably seen this chart before. If you've been a client of LifeWorks for a while, I'm going to run through it again really quickly here because I think it's foundational just to make sure everybody has this in the back of their mind as we start talking about performance, and then as we move into our Q&A session, where we will talk about some of the things that Alex and his team are following and tracking and interesting economic data points that we watch. What you're seeing here is what we call our tranche system, or the LifeWorks investment methodology. Tranche 1 essentially represents all of the cash flow needs that a client has to take out of their investment portfolio, all of their income needs for the next 3 years, from today till 3 years into the future. Tranche 2 represents what we also believe is one of the toughest or the most challenging periods of time to invest for, which is this intermediate time range, years 4 through 10. Now, part of the reason why we believe that to be one of the toughest time periods to invest for is, well, inflation's been a great example. We have tried to minimize the amount of fixed income or bonds that our clients are holding in their investment portfolios because for the last 40 years since the early 80s, but for sure the last couple of years, we've been at zero bound interest rates or a declining interest rate environment. So fixed income and bonds have not been yielding enough interest or income to keep up with inflation, right? But at the same time, we don't want to be fully into equities in that space, right, in tranche 2 for our clients, for you, because, well, we've also seen this year, right, economic events and uncertainty can happen and equity prices can fall rather quickly. We also saw that during, February, March, April of 2020 with the COVID drawdown. So tranche 2 is a difficult thing. So we've done some things in here over the last few years for our clients that have worked out really, really well. And it's not us claiming that we had some crystal ball or could kind of foresee the future, but you can look at the economic landscape and you can look at macro events and have the ability to intelligently position assets. So we've been using hedging strategies for our clients who are close to retirement. We've been using Treasury inflation protected securities for younger clients that have a longer timeline to try and hedge against the risk of inflation and at the same time also generate real positive returns. Okay, tranche 3 real quick is just what it says there. It's everything from 10 plus years into the future. So if you're a younger client watching this and you don't need to spend money out of your investment accounts for 10 plus years into the future, it's likely that your investments or your section of your investment portfolio that we call tranche 3 is going to be mostly long-term equity or investments that we believe have the ability to appreciate and grow over time. So we might have gold in there, real estate, long-term equities, Bitcoin for some of you. That's a whole nother webinar discussion that we should run here shortly around digital assets and what's going on in that space. But just know this, the headline here I think is the important one. We can time when our clients, you need to spend your money for the most part, but we can't time the market. So in everything that Alex just talked about and the stuff that I'll talk about going forward, then during Q&A, just know we're not trying to guess where the market's going to wind up. In fact, while we are conscious of what's going on and we're concerned about certain things, we also recognize that that shouldn't be where our focus is. Our focus should be designing robust and durable investment strategies, which Alex and his team have done, using scientific factors that we know over time will generate the outcome that our clients need. Okay, so with that discussion in mind, let's just shift gears. And again, Alex kind of drew the short straw, so he got to talk about inflation, some of the bad things going on, some of the negative aspects, indicators pointing to a recession, indicators pointing to there being a divergence between what the market expects interest rates to be versus where the Fed expects it to be. I get to talk about how LifeWorks investment strategies have done so far year to date in 2022. So as a quick reminder here, this is just a screen grab from our website. I'm not going to spend much time here, but if you want to learn more about our investment strategies, you can reach out to one of your advisors. We also are unique in our industry in that we publish in a transparent way all of our methodologies, our research, and the factors that we use for the building blocks of our investment strategies, which then become the building blocks for you, our clients' investment portfolios. So if you go to lifeworksadvisors.com, you can scroll about halfway down on the homepage and you can see our investment strategies. You click in there. Each one of these has fact sheets, and we update those fact sheets quarterly with the performance of the strategies, the top 10 holdings, other important portfolio metrics, et cetera, things like that. So Diversified Premia, real quick, this green box that's on your far left, that's our flagship multi-factor strategy. Now, I won't have time to get into what factors are today in any depth, but just know factors are essentially scientifically proven elements or factors that we can use to screen investments and that have been proven over time to have to create additional value for you, the investor. So diversified Premia is our quality factor strategy and our opportunity factor strategy. And then it uses smart beta, which is a quantitative investment technique, to reduce any unrewarded risks in the portfolio. So think about diversified Premia as a blend between quality, which maybe you could also think of as value, and opportunity, which you could also maybe associate with growth stocks, technology names, things like that. And then we also have them broken out in separate pieces here as well. So let's dive right in and let's just see how they have performed so far this year. All right, so what we have here is the dark blue plot line is diversified Premia, which is our flagship factor equity strategy. The orange line is the S&P 500, and all of these numbers are gross of fees, just for simplification for everybody watching. They are gross of fees, and also as of last Friday's close, December 19th market close. Monday's close. So what we can see here is that diversified Premia has had a significant outperformance over the S&P 500 this year. The gray line in the middle is just to give a good point of reference. The gray line in the middle is assuming what the industry might call a balanced portfolio, 60% equities, 40% bonds, okay? Because the fixed income market, the bond market, has also had a pretty terrible year. In fact, I'll maybe go back a couple slides here in just a second and show you guys the fixed income market and the equity market have been highly correlated, meaning for years investors have thought, and most of the advisors have told their clients, that bonds or fixed income are negatively correlated to equities, meaning bonds provide diversification inside of an investment portfolio. Well, what we've seen this year with this regime shift, with inflation running rampant, with the Fed raising rates, is that the returns on bonds and fixed income have been correlated with equities, meaning both of them have fallen together. Fixed income and bonds have provided virtually no diversification or downside protection for investors in 2022, okay? All right, quality. How has quality performed against its benchmarks? Now, quality is looking at factors that some people might attribute to value investing. So it's looking at profitability, it's looking at earnings. My audio timing is a little off, got it, okay. And what we can see here is, again, orange is S&P 500. This time the more royal blue line at the top, that's the quality strategy. And so for those of you that have an oversized position in quality, or have more of the quality strategy in your fund or your investment portfolio, you're having an even better year than people that had a 60-40 mix of equities and bonds. All right, one more here real quick, which is the performance of LifeWorks investment strategies since inception, which would be early May of 2021. So quick history for those of you that are new clients, LifeWorks started in the middle of 2017 after Kurt Van Dyken and myself left a large institution, started LifeWorks as a registered investment advisor, as an independent fiduciary. We then merged with Aimvest Technologies in early 2021. Aimvest was started by Alex, our Chief Investment Officer, and his partner, Hugo Castellan. And they brought their quantitative investment methodologies and a lot of really, really robust investment intellectual property and tools for our clients to table. And so we've been tracking the return on these strategies since inception, which is May. And so what we can see here, and I think this is really important too, is not only did our multi-factor strategies outperform the market last year when the market was having a really, really great year, they also have been outperforming the market in a down year, which is 2022. So if we look back from inception to today, what we see is our diversified Premia, which is the dark blue line, has had about a 1.65% rate of return, while the S&P 500's been negative 8.69. Our quality has been about a 3.5% rate of return, and our opportunity has been a -6. All of our strategies have outperformed the S&P 500 with less volatility, which is something that is extremely important. Now, one other way to look at this, and this will be our last kind of chart like this, and then we'll click over to some different slides. We also calculate the excess return, right? Which means what's the amount of additional return that LifeWorks through our investment strategies has generated for our clients. And again, this is gross of fees that we can just look at it across all of our clients, right? But since inception in early May of 2021, our multi-factor investment strategies have generated an extra 10% rate of return above the S&P 500. Now, I will end this presentation with one of my favorite quotes, and it's worth mentioning now, that luck is the residue of design. Luck is a fact, but it's not a factor, meaning it does play a role, but it is not a driving role. And luck, the way we define it, is that when you take hard work and intelligence and they're combined at their best, this is the result. An analogy would be somebody watches an athlete. In fact, everybody in my household was gathered on the TV on Sunday watching the World Cup final. We were all rooting for France, obviously, because Alex and Hugo are from France, and oh, hang on, Alex just asked me a question. Okay, and it's easy to look at somebody like Lionel Messi or Mbappe or one of those top-notch football athletes and just think, oh, they must have been lucky they were born that way, and forget about the fact that they have tens of thousands of hours of practice, of exercise, of hard work, of determination, and skill combined, right? So when we think about LifeWorks and the performance of our investment strategies, when we think about what that means, don't mishear us that we're necessarily bragging about us being, able to see the future, that we predicted the market. That's not the case. But know that there was intentionality, there was hard work, there was effort, there was intelligence that was combined to build these investment strategies for you, our client, right? And the combination of that hard work, that intelligence, the scientific research that were put into this has resulted in this outperformance that we see here. All right, I'm almost done with my presentation here, and then we'll jump over to the Q&A. All right, let's just put a couple of numbers on this just to make it a little bit easier to kind of see here off the plot line. I'm going to pick out a couple of them that I think are important, right? Since inception, the return of our factor strategies, our flagship strategy, which we call diversified Premia versus the benchmark, right? Couple of important things here is what we can see is that our upside capture ratio, which is down here on the bottom of the screen, I'll put my cursor on it, is about 113%, which means when the market is doing well, we're doing well, but we're doing better by about 13%. When the market's down, the downside capture ratio at 91% means that when the S&P 500 falls, we don't fall as far and we don't have as much volatility. And let's just look at 2022 real quick here, and then we'll wrap up. Annualized return for diversified Premia, this is again through 12/19, so through Monday's close. Annualized return for diversified Premia is negative 12.5%, where the S&P is down almost 20. The alpha, the additional return that we've created, just this year alone is almost 6.5%. And our upside capture ratios, downside capture ratios, similar to the one since inception, about 114% upside capture ratio, which means, again, when the S&P 500 is going up, we're actually capturing more of that. And when the S&P 500 is going down, we're not falling as far or as fast. So hats off to the investment team here at LifeWorks, which I don't lead. That's led by Alex, Hugo, Brett Smith, for the tireless effort that they put into the research and the strategies. I should also mention Shannon as well. I think she's on here as well, one of our quantitative investment managers. They do a tremendous job for all of our clients, you guys included. And there's hours and hours and hours and hours and hours every week put into researching and questioning and improving the design of our investment strategies, and then also proving them out. In our Q&A session, one of the things that I'm going to ask Alex to talk about next is something that he's mentioned to me a couple of times, and I find it really fascinating, where the factors that are the selection methods we use for identifying the equities to invest in, the factors are designed in such a way, and the investment strategy is designed in such a way that Alex and Hugo and his team can look at things that are happening in the market and know exactly where our investment strategies are going to go without even needing to look at where the market is at on that given day. So it's really, really key to know that our investment team here at LifeWorks can not only explain where the excess returns are coming, but also what the main market factors are that drive the returns in our portfolios. So when you hear Alex or myself or somebody in our team talking about inflation, China, interest rates, things like this, just know that those are economic events that we understand how those are going to impact our investment strategies because of the design and how we built them, which is pretty key. So I'm going to have Alex maybe unpack that a little bit in our Q&A. Let me leave you guys with one of my favorite quotes and then maybe a closing thought here, and then we'll jump over and take live questions. I'll probably keep running this one because every day, not every day, but multiple times a week, I talk with advisors around the country, and I talk with prospects and clients that ask questions about, timing the market, or I'll talk with an advisor group, I'll speak at an event, and a lot of the advisors are trying to guess where the market's going, right? And I cannot stress enough that luck is a fact, but it's not a factor. So things worthwhile generally don't just happen. Luck is a fact, but it shouldn't be a factor. Good luck is what is left over after intelligence and effort have combined at their best. Luck is the residue of design. The performance of LifeWorks strategies, the results we've generated for our clients, the intentionality with which we built our financial planning system, our investment methodology, there is a reason why other firms in the industry haven't done it. One, because it takes a lot of work. Two, it takes a lot of investment in technology to be able to do this and do this on a personalized basis for each and every client. So the majority of the industry and the majority of advisors give the majority of their clients the same advice and the same model portfolios. And at LifeWorks, every one of our clients, and you guys watching this are included in this, every one of our clients has a portfolio that's built specifically for your financial plan and that's personalized to you. And that is something that we are very, very proud of. I get to go to industry events. I've been doing a lot of speaking in the last year and a half at industry conferences. And when I get to stand up and say, every one of our clients has an investment portfolio that's built specifically for their financial needs and for their family's financial plan, I have advisors and firm leaders come up to me all the time and say, how do you guys do that? And I said, well, the answer is simple, but the execution is difficult. The answer is simple because it's the right thing to do for you, our clients. It's the right benchmark. Your financial plan should be the benchmark, not the S&P 500 or not a model portfolio's return or not some other manager. But it's difficult to execute on. And so hats off to our team here at LifeWorks, Alex and Hugo, Shannon and Brett on the investment team side, and then all the financial advisors that you work with, because the combination of your financial advisor helping you build a really durable, solid, and clear financial plan, that's the input that feeds into our investment engine that we then use to build your investment portfolio with the strategies that I've talked about here today as the building blocks and the benchmark for it. So luck is the residue of design. Good outcomes are the residue of intelligence and hard work and effort. And I am grateful every day that I have the opportunity to lead this team of quantitative investment scientists and researchers, portfolio managers, advisors, CPAs, on a quest to help you, our client, make wise decisions with your family and financial assets. It's what gets me up every day. It's what keeps our team motivated. It's what we have right at the forefront of everything we do when we're building something. Even when we're putting on an event like this, we're constantly thinking, how can we help our clients? How can we bring the knowledge, the information that you need to make wise decisions with your family and financial wealth? And that is our mission. So we are grateful to have you as clients of LifeWorks. We believe that we get to do noble work, helping you manage your wealth across multiple generations and build for the future is something that we don't take lightly, and we are humbled and grateful that you've chosen us to help you in this endeavor. So thank you for being a client of LifeWorks. Thank you for being here today. And we look forward to the future with optimism. We have no idea what 2023 is going to bring, but we are certain that how we've designed our strategies, how we've built our planning system, and how we're working and serving you is going to allow us to help you make the best decisions you can possibly make going forward. So thank you for your time and attention. I hope you found this presentation to be interesting and informative. And if you have time, stick around. Our Q&A session is going to be open for maybe 30 to 45 minutes, depending on how many people stick around. So again, in the bottom left-hand corner of your screen, you'll see a little hamburger menu icon. Click on that and then click on the Q&A space, and Alex and I will see you over there shortly, where we will be fielding questions from you in real time. So thank you guys so much again. I'm Ron Bullis, the CEO and co-founder of LifeWorks Advisors. If you have to leave now to get back to work or your day, thank you again for being here. Have a blessed week and a Merry Christmas, and we hope to see you on one of our events again here really soon.